Today, we talk about the top 2024 real estate markets that I'm looking at. Each and every year, we look at the markets we're investing in and potentially new markets that we might want to consider for the next year. We typically have 8 different investment drivers that make our decision into which markets we decide to invest. The first one being interest rates and cost of capital. As you know, that's a little squirrely right now with the high costs of both equity and debt. 2 would be construction and renovation costs. 3 are land costs. 4, property taxes specifically, and operational costs like labor costs. NIMBYism, or not in my backyard. Sometimes it's hard to do deals in certain markets based on the political environment and specifically neighborhoods. Population, job, and income growth. State and local taxes, and of course, infrastructure, which also means transportation or ease of transportation. For 2024, we're also concerned about 4 main things. 1, household savings rates are below normal levels, and consumers have depleted most of their pandemic savings, which could reduce further consumer spending on things like housing. This is something to watch because it severely affects where people go. Student loan payments are resuming, which could further reduce consumer spending. Number 3, oil prices. As you know, oil affects everything. It affects even the transportation of the cost of food to your local grocery store. And of course, the obvious is to and from work or vacationing and things like that. 4, banks are tightening their lending standards. Now, this is a big one. Now, they're doing that for a couple reasons. 1, a couple banks went down in 2023. And 2, maturities are starting to hit for a lot of commercial properties, which is going to be very interesting for 2024 to see exactly how that affects the bank's balance sheets. We all know that we need great bank health in order to come out of this real estate market the way we came in. Stay tuned till the end because I'll tell you what my 10 real estate markets are for 2024. Now, as we're gathering information to try to figure out where to be, we look at lots of different sources, including the Department of Motor Vehicles when people turn in their driver's licenses, or the U.S. Postal Services as they change their address. A couple that I show you here are U-Haul on the left and United Van Lines on the right. There's great data from these moving companies that track one-way rentals from one point to another, which of course typically mean that people are moving permanently. The top states for U-Haul are on the left, Texas leading the way, and the top states for United Van Lines are on the right, with Vermont leading the way. One thing to note, there's some really good data here that also talks about the states that people are moving out the most. Those are the states that you might want to consider being careful investing in the next couple of years. One of the things that just came out recently, finally, was the U.S. Department of Commerce Census Bureau data. On the top of this chart, you'll see the percent change in state population from the middle of 2021 to the middle of 2022. Anything that's dark green is showing more than a 1% change in the population growth for that particular state. It's important to realize that this is 2 years of data here showing exactly where people are moving based on the U.S. Department of Commerce. And hopefully you can see here there are some clear winners. As I always like to say about real estate needs people for it to perform. While this data is high level and it's an entire state, which is huge, you obviously do have to drill down into the individual submarkets, and there could even be performing submarkets in areas where the state as a whole is losing population. So one of the most interesting trends from the U.S. Census data is that the South has driven the majority of the population growth last year for the entire nation. It accounted for 87% of the nation's growth, and the region added 1.4 million residents, increasing the population to over 130 million. The 2 charts at the bottom are important to understand. The chart on the left represents the 10 most populous states. So sometimes as you're looking at a state, for example, like California, you can see that it had 39.5 million people in April of 2020, and 2 years later, it had lost about 500,000 people. Fast forward another year, it continues to lose even more. Now, that's not necessarily all the story, as you know. It is important to understand that for the first time in over 20 years, that California's net migration is heading out as opposed to in. So if you consider to invest in California, it would stand to reason that you would want to dig deeper into these reasons. So as we go down the list for the top 10, you can see that California was a net loser, as was New York, Pennsylvania, Illinois, Ohio, barely, and Michigan. Now let's move over to the top 10 states by numeric growth, which of course is the most important thing in my opinion, because these count as real people putting pressure on an existing infrastructure in a particular area. So for 2023, again, top Texas, Florida, North Carolina, Georgia, South Carolina, Tennessee, Arizona, Virginia, Colorado, and Utah. Now, what you really want to do from this point, take a look at this data and drill down even deeper. And so what you're going to want to do for the next step, which is what we did on our top 10, is you want to find out exactly of those numbers, where are those people moving specifically to what city and what county. As these people move to these areas, it puts a tremendous amount of pressure on the infrastructure, of course, in housing, both in residential and in rentals, but in the school system, in the medical system, and also just with food and the grocery stores and the restaurants and all the things that you can think of that happen when you get this many people moving to a particular area. This is specifically what creates prices to go up. High demand, low supply, higher prices. So if you're going to invest, you want to find out where people are going and invest there. One very interesting stat that we look at is population growth. Of course, these are natural. These are people that are born and people that have died. And then, of course, immigration. And you can see where the pandemic kicked in COVID, where we had the high spike in deaths, but it's starting to now normalize, and we're starting to see net population growth again. This is a very interesting statistic of people that were going to the office every single day just a few years ago and are now working from home. So obviously, if you're investing in office buildings, this is really important. But if you put your multifamily hat on or your single family hat, this can also be a big driver of people's habits of what they're doing now. They don't necessarily have to be so close to work anymore if the majority of them are working from somewhere else. Traditionally, people like to live near where they work, but in these particular locations, things have changed. And therefore, their buying habits, their renting habits, their owning habits, all will also change. So our top 10 markets: Nashville, Phoenix, Dallas, Atlanta, Austin, San Diego, Boston, San Antonio, Raleigh, Durham, and Seattle. One thing to understand is that you cannot fight these demographic trends. People are definitely moving for good weather, more affordable locations, safety, affordability throughout the United States. And I don't see anything that's going to change this in the foreseeable future. The U.S. population is not growing that fast, as pointed out in that earlier chart. But the distribution of people is changing, both in numbers and in geography. These shifts are going to present opportunities for some housing markets for those who pay close attention to these demographic changes and act upon them. Pay attention to what I call the double down markets, which are markets that both businesses and people want to be in. And of course, lastly, what I call the smile markets. The smile, like at the bottom of the United States. The markets, particularly in the Sun Belt areas, people are moving to. If you look at the 50-year averages, it's going to continue.